time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
Reitmans Canada is a Canadian retailing company focusing on women's clothing under the brands Reitmans, Penningtons, and RW & Co. Reitmans Canada, symbol RET.A and symbol RET on the TSX Venture Exchange. The shares trading under RET carry a voting right, and they trade for roughly $4.27, while the shares under RET.A don't carry that voting right and trade for quite a big discount at $3.57. It's not unusual for companies to have non-voting and voting shares, but it is unusual for them to have a 70-cent price difference, in this case, which is roughly, let's say, 20% or so. It's merely just the voting right difference. You're not getting a dividend difference like you'll see in some share structures. 1-to-1, except for the voting rights, so it's a quite big difference for that. But the voting shares are still largely in control of the Reitman family, giving them control over the company, so they don't trade nearly as much as the non-voting shares, so they're generally a better price comparison. So that's probably using for my PEs and so on. Reitmans has been struggling since 2020. The company filed for protection from creditors under the Companies Creditor Arrangement Act, or CCAA, in May of 2020 at the height of COVID. After 19 months, the company emerged from restructuring, shedding roughly 160 stores, 2 brands, and 1,400 employees. The company now has roughly 404 stores across its 3 ongoing brands. Moving to the income statement. For fiscal Q3 2023, ending October 29th, 2022, the company has had sales growth of 15.4% to $205.6 million. The company saw both higher transaction counts and higher transaction values, as well as increasing sales due to its growing e-commerce segment, offset partially by net 9 stores closings over the years. The company saw significantly higher selling, distribution, and administration expenses, increasing 28.3% to $102.4 million. The increase was largely due to operating costs and wages and performance incentives, advertising, and leases being connected to sales. The result of higher SG&A is a lower bottom line year over year, falling to roughly 30 cents per share for the quarter from 45 cents for continuing operations. We're using continuing operations as a comparison because the company was still undergoing restructuring during the prior quarter, or in the prior year for the quarter. The company booked a tax expense of only $67,000 for the quarter, and in the previous quarters it actually had booked a taxable benefit. So they are not actually being taxed right now, and they will be in the future, assuming they continue with this profitability. So if 1-to-1, all else stays the same, you'd actually see lower earnings as tax actually comes in play. On a year-to-date basis, however, we are seeing slightly better results, with sales increasing 24.8% and SG&A only increasing 36.9%, and continuing EPS increasing 9.6% to $1.03 per share from 94 cents per share. The better results year-to-date compared to the quarter is because the first half of fiscal 2022 was weak, given the company was still being impacted from COVID. So it's just comparisons were weaker overall. Moving on to the balance sheet. The company holds $64 million in cash while having lease liabilities of $77 million with no other financial debt, like bonds or anything in that matter. As the company is primarily a brick and mortar retailer at this time, the high lease liability is just not unexpected. It's part of the business. Net debt, including leases, is $13 million, which is reasonable given the size of the company. And assuming sales don't collapse like they did in 2020, it shouldn't be a near-term risk, as it wasn't the balance sheet itself which was the issue for their initial restructuring. Leases, however, have substantially increased on the books due to the restructuring, shifting leases to a standard fixed rate payment from a contingent percentage of sales. This increases the right of use asset, as well as the liability side of the leases. So overall, it's just really an accounting shift, and the number of the leases are relatively similar in purpose. It's just because they shifted from the percentage of sales to a fixed rate, which increases the lease, but it also increases the right of use asset. So overall, it's still roughly the same company as far as the actual operations go. Given the recent restructuring, the balance sheet is relatively strong, but that was not the catalyst for its initial restructuring. It was really the evisceration of its sales. So, moving to valuation. The valuation metrics are quite weak in validity, as the company has shifted significant over the past year, For example, Gap price to earnings is just over 1 times, so you can't really use that. That number's effectively meaningless. So, as the major restructuring shifts occurred in Q4 2022, we need to adjust some of the accounting figures. So we're going off non-GAAP at this point, which does normally make things weaker. The main being a settlement in liabilities and a gain of $88.6 million. Once the company exited creditor protection, the result in PE is roughly 3.1 times. Further, the company had a slight taxable benefit. So if we add back taxes at 25%, this is just a rough value, we'd get roughly 4.1 times PE, which is still quite low, but it's not as appealing as if you're just taking the GAAP earnings, which I have seen some people referencing in articles I read online. Reitmans is shaping up to be a positive turnaround story at this rate, but still has significant obstacles to overcome at this time. External to the company, we could see consumer slowdown in consumer discretionary spending. So retail, anything like that is going to be hit if there is a harsh recession, or even if there's a mild one, they would see a slowdown in that matter. As well, though, internal, the company needs to stabilize its earnings. The earnings are all over the place, which is also why the valuation metrics are weak. We're not seeing consistency. Like the Q1 for fiscal 2023 was a slight loss. Q2 was about 70 cents. Then Q3, the most recent, was about 30 cents. So it's quite fluctuating. It's not consistent. They don't have their usual seasonality, which you'd see in retail because of the restructuring. So you don't have much to go off of their actual financials in consistency terms. But Q4 does release on April 13th, so we can see if they are able to stabilize their earnings going forward.
Who here has shopped at Reitmans anytime over the last year?
Brennan's been to many women's stores.
Really?
No, I haven't.
Women's clothing is right up his alley.
I had my hand up.
Yeah, no,
it's
the valuations look good, although the fluctuations of earnings is very concerning. We do have another company, like there's one retailer we have in coverage that we like and have invested in long term. And, I'm not going to say the name of the company today because we're actually looking to maybe upgrade it in the near term. But Reitmans, if you look back to like 2014, for example, when we can start comparing it to this company when they went public, Reitmans was doing $960 million in revenues then. This company was doing $376 million in revenues. Well, if you fast forward to today, Reitmans is doing $778 million on a trailing basis. This company is doing $2 billion. So gone from 376 to $2 billion. Reitmans has gone from 960 million to 778 million. The valuation you are paying for the company that I'm talking about that we do have coverage is higher, significantly higher, but the consistency in terms of growth, it didn't just come out of receivership, which is always a good sign that you're not just coming out of receivership. So you're paying on a multiple basis, way higher. I mean, I think it's about 20 times next year's earnings, but they expect 18 to 20+% growth. And this company has never closed any of its stores, where Reitmans, I've looked at them in the past, there's usually a line item that says stores open, stores closed, and then you have a net store gain or decline in the year. Those are because the business in those stores isn't doing well. So, I mean, and sometimes when you have a large store base, there's a market, the growth in a market they're in fades out. So but a lot of the time it's people aren't buying clothes in those stores. That's the issue, right? So, it looks like it could be a turnaround story, but
I think
Aaron talked last week about Warren Buffett paying a little bit more for a really high quality business, in the 18 to 20 times, paying that range. If you consistently think it's going to grow at 15 to 20%, that's a way to compound your income or earnings or investment, in a company over the long term. And, that's why we would favor this name versus that. Although, as a speculation, we're looking again into Reitmans, but it does have high variability, and that's why it has low valuations, because investors aren't trusting the earnings to a degree right now and the business's sustainability long term. Sorry, Aaron, I cut you. You had something to say, didn't you, Aaron? You got nothing to say. I thought your screen was frozen there, honestly. We're just looking at Aaron. He looks like a statue. It's unbelievable.
Listen, I think that in the retail space, you really need a niche. And the company that you're talking about in the retail space, I think they have one. Whereas if you're one of those retail companies where you're just kind of a, you're just kind of a mid-end, maybe not totally targeted business.
You don't have a
like
bunch of
you don't have
social
like
influencers
a loyal
posting.
niche market you targeted that is it's to me it's most of the people that I know, like my wife, who purchases things nowadays, purchases them online, right? So unless there's a reason for you to kind of like walk into like a nice shop or go to some place where you're getting, you're going to get like an incredibly good deal, like I don't know, maybe I don't know how Winners is doing, but something like that. But if you're kind of in that mid range, I just think it's hard for retail. And to me, the valuation when it's a business that is struggling or where there's a lot of uncertainty is really, I wouldn't even look at valuation in that case. I would focus more on the health of the business, because it's really easy, even if revenues stay flat, even if revenues go up a little bit, it's really easy for the company to experience enough margin pressure where earnings are cut in half. And then, where I'm not saying that that's going to happen in this case, but then what good is the valuation based on last year's earnings there, right? You need to have some certainty that the business is healthy, and that earnings are stable or growing.
One thing of note with Reitmans is Brennan's favorite royal, Meghan Markle, was at one point a spokesperson for Reitmans. So, I mean, as for him, that's why he was there.
Well, there you go. Now I've changed my entire opinion on the company. Yeah.
This isn't true, but I just want to even bring up Lululemon right now. Like, what a great, like they started in Vancouver. Is that correct? Yeah. And even last week, Aaron was talking about how Warren Buffett said, 12 stocks over 50 years can change, your life. Well, one of my friends, Ryland, his uncle actually bought Lululemon way back.
He bought the entire company,
and it has absolutely changed his life because of the gain that it has done. He did not buy the entire company, but I mean, he's up over 2,000%, over that period. And again, going back, they have a great niche. They've got influencers. Like my buddy Ozzy was in the store the other day with his girlfriend, and they were laughing because all of a sudden, out of nowhere, one of the sales clerks got on a table and was like, flash sale, all pants are buy one, get two pants. And they were like, oh, this is a great deal. This is a one time a day kind of thing. Well, they came later that day, and I guess every 30 minutes they have these flash sales trying to get, consumers in the store to think that they're getting a great deal.
I thought you were going to say really, Ozzy was a
this
social
is just an
influencer.
Ongoing thing.
Or he was flashing.
I just thought that was kind of funny.
I found that story believable up to the point
you blanked out after
you
you heard that. Or what?
No.
Yeah.